Corporate finance practice problem using Excel. Buy new fixed asset or keep the old one decision. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information left-hand side, we're going to populate that into the blue area on the right-hand side. We're going to have a typical type of decision-making process here, not one that happens every day, but one that could be a significant one and happen and affect future time periods, that being whether we should stick with the old piece of equipment that we currently have or whether we should buy a newer piece of equipment that might increase our efficiency. This is similar to a decision on the personal side, like should I keep my old car or should I buy a new car, for example. Obviously, on the business side, we're focused more on the profit generation of it. On the personal side, we might be focused more on, would it increase my pleasure in terms of having the car, which gets a little difficult. On the business side, it gets a little difficult because we also have to take into consideration the tax impact, and the tax impact will depend on the depreciation of the fixed asset. So we need to take a look at the incremental differences then. We want to separate out what will be the differences under the old and the new, and whether or not then it would be worthwhile to purchase the new piece of equipment. So obviously, some things we have to take into consideration are, can we sell the old piece of equipment if we're going to replace it? How much could we get? How much would the new piece of equipment cost then? And get basically our net impact on that type of side of things. And then the new piece of equipment, what will be the added benefit? Meaning, what would the increase in efficiency result in terms of revenue generation? As we consider these, we also have to take into consideration the depreciation, because the depreciation has an impact on the taxes, which is a cash flow item. So like with other kind of scenarios, we're looking into a future type scenario. We want to look at it on a cash basis so we can use our cash flow analysis to make our decision. But we have this accrual problem of the depreciation, not because it's accrual in and of itself, but because the taxes are going to be impacted based on that accrual concept of depreciation, and the taxes are a cash-based item that we need to take into consideration. Okay, so here's what we have. We got the current fixed asset, 5-year makers fixed asset, $75,000 a year ago that was purchased. It was purchased 2 years ago, we're going to say. The market price is the $33,000. So in other words, it was put on the books for $75,000 2 years ago, and then we have the market price at the $33,000 is what we could sell it for now if we chose to sell it, being the decision if we decided to replace it. So the possible new equipment we're going to say is the 5-year makers fixed asset, a new 5-year makers fixed asset, which would cost $210,000. So the first question would be, well, how much added efficiency would that $210,000 give us? So we're going to say the added cost savings of the new equipment, meaning it being more efficient, and this would have to take some calculations to figure this out, of course. How much would it save us? And we might be taking into consideration things like time, less work, man hours that would be involved, and so on and so forth, possibly to come into what we think the yearly savings would be. So we'd have to come up to that. We're going to say year 1, year 2, 3, 4, and 5, and 6, 75,000, 78,000, 81,000, 73,000, 70,000, and 65,000. The tax rate's going to be 35%, and the cost of capital at the 12%. So those are going to be the inflows. Now we know if we sell the piece of equipment, if we sell the old piece of equipment, we're thinking we can get the $33,000 on it. So now we'd also like to consider what the depreciation is at this point in time to see what our gain or loss would be. Now we're thinking about this on a tax basis because we want to take into consideration the tax impact of this transaction. So let's figure out our maker's depreciation on the old piece of equipment, which we said was 5-year piece of equipment. So I'm going to label this from 1, 2, 3, 4, 5, 6. I'm not going to recalculate it this time for the makers, which is basically, as we talked about in prior presentations, kind of like a modified double declining half-year convention depreciation. I'm going to take this straight from our table this time, and you could find this if you go to the IRS website and type in publication 946 or pub 946, irs.gov, pub 946. We're looking at the 5-year property down here in the table 1A, and I'm just going to pick up these percents, the 20, the 32, the 19.2, the 11.52, 11.52, and the 5.6 or 76. And so all I'm going to do is say that this is going to be Then the amount, 75,000, was how much it would cost. I'm just going to copy that down, copying that down. I did that a little trick. Let me do it this way. I could say this equals that number, and then I'm going to say F4 on the keyboard, make it an absolute reference, and then grab that number, fill handle, copy it on down. And then I'm just going to add my percents, which are 0.2, and let's make this whole column percents. Before I do this, I'll percentify the whole column. 0.2, and then 0.32, 0.192, 0.1152, 0.1152, 0.0576. Those are the amounts that we got from the table. I'm going to add a couple decimals, selecting this whole thing, number group, add a couple decimals, and there we have it. Hopefully I got all those correct. If we sum these up, let's do the sum just to double check. That gives us one double check here. Should add up to 100, and it does, so that gives me some confidence that I did that correctly. Let's go ahead and multiply this out. This is going to be then the 75,000 times the 20%. I'm just going to autofill that on down, copying this on down. So there we have it. And so if I double click on this, we're just taking the 75,000 cost times the double declining kind of percent that was given, or the maker's percent that was given on the table we just looked at. And that gives us our depreciation. So I'm going to add this up, depreciation there. And so I'm going to sum that up. So the depreciation at the end of the 6 years, because it's 5-year property and there's a half-year convention. So that's kind of why there's 6 years. You could imagine half of it in year 1 and year 6, although it's a 6-year thing. And the end, because it's double declining, it's kind of a plug at the end and whatnot, as we talked about in prior presentations. And this will then be the total. And so there we have it. Now, we sold this thing, we're saying, at the end of year 2. So I'll make this kind of yellow right there. So we're thinking about selling it, or this is where we are at this point in time. So if we were to sell it, accumulated depreciation at this point, the amount that we have expensed for taxes is $39,000. So the book tax depreciation, I know that's confusing, but the cost minus the accumulated depreciation, usually expressed as the book value on a tax basis, would then be the cost minus these two amounts. So let's calculate that. Let's calculate the tax gain loss on sale. So we would then say, all right, well, the sales price was we're saying is the $33,000. And then we're going to pick up, I'll call it the depreciated cost, which is kind of like the book value, but on a tax basis, meaning cost minus the accumulated depreciation. So I'll pick up the cost and then the accumulated depreciation. So cost was 75. I'm going to do this a little bit faster because this is a long problem. And then less the ACC depre, accumulated depreciation up to this point, is the 15 and the 24. So I'll say it's the 15 plus the 24. Underline that, font group and underline, and that's going to give us our depreciated cost. Depreciated cost. And this is going to be the 75 minus the 39. And then I'll underline that, font group underline. I'll indent these three, alignment, indent, this way, indent, and then indent that one again. And that's going to give us our tax, this is a loss on sale. So that's going to be the 33 minus the 36,000. And that means that we have a loss there. We could have a tax benefit related to the loss. Now note, it could be quite possible that you end up with a gain when you sell it because of over depreciation, meaning just realize that the fact that we're double declining the depreciation up front, and you might have like 179 depreciation as well as other kind of special depreciation depending on the year that you're putting it in, which oftentimes front loads the amount of depreciation. If you front load the amount of depreciation, then when you sell the thing, then it's going to have a lesser depreciated cost or kind of book value on a tax basis, and that could result in a gain. And a gain for taxes is bad, right? A loss for taxes is kind of good. So just realize that that's one of the things that's kind of the cost of allowing us or being able to have the accelerated depreciation. So in this case, we have a loss, so we're going to have cash flow come in of the 33,000, but on a tax basis, we're going to have a loss due to the fact that our depreciated cost is still 36,000. So we have 36,000 thing that we're thinking we're kind of selling that we have on our books for, and we only sold it for 33,000, so we have that loss. But we're going to get cash of the 33,000. All right, so the tax benefit then is going to be the loss of the 3,000 times the tax rate, which would be equal to, we're saying the 35 over here, I believe we had 35%, making that a percent by going to the numbers group, percentify, then font group and underline. Remember that this might be the last tax rate, the marginal tax rate, because we're making this decision or thinking about doing so on the margin. So we might not be using the average rate here, but the last rate, the marginal rate. And that's going to be the tax benefit then equal to the 3,000 times the 35%. So the cash flow that we're thinking about, what would happen here is the sales price. That's what we would get in cash, even though we have that loss. So, but we would be getting the 33,000, and then we'd have this tax benefit that we just calculated up top. The tax benefit here, I'm going to make that a positive number by saying negative the 1050. That's kind of like a cash inflow. So that means, you know, even though we had a loss on a tax basis, we're looking for the cash flow here for our decision-making purposes. So we're going to have then the sale net cash inflow, we'll call it, is going to be equal to the 33,000 plus the tax benefit that we're going to get of the 3450. So we're thinking when we sell it, the cash flow is going to be the 3450 is our idea. That's going to be the inflow if we decide to sell. So cash inflow of the new equipment after. Now, if we compare that to the cost of the new equipment, we're going to say, okay, well, the cost of the new equipment is going to be equal to, we said, the 210. So if we bought the new equipment, we get the 210. But then we've got the sale of the old equipment that's going to result in an inflow of the 3450. So the cost, this would be an outflow, this would be an inflow now. So the net cost to us of the new equipment, which I'm going to call here cash inflow of the new equipment, would be the 210 minus the 3450. So really it's costing us, we're thinking, 175,950 after taking into consideration the sale of the old equipment and the tax benefit related to it. So now we have this issue where we've got these benefits, the inflows that we think are going to be happening. We need to take into consideration the depreciation on a tax basis, just like we did with prior presentations, but it's a little bit more complex because what we need to do in a decision process is take the difference between the depreciation from the old equipment to the new equipment. So to do that, we got to say, all right, well, what's the depreciation if we put on the books the new equipment? Same rates and everything. So it'd be 1, 2, 3, 4, 5, 6, and then total. But now we're saying the cost of the new equipment is that 210. So the cost of the new equipment is the 210. The rest of the table is basically the same because it's still the same category of equipment for taxation. So I'm going to say then this is going to be equal. Let's do it this way. Let's say 210 and then select F4 on the keyboard, make it an absolute reference. I'm going to copy that down, autofill it down to period 6. And then I'm going to use my same percent. So I'm going to go to equals the percents that we got to here, which is in the publication that we talked about on the IRS website. You can look it up there to get to a quicker way to get to our percents. I'm then going to highlight this whole column, go to the Home tab, Clipboard, and Format Paint brush it. So copying the format, and I'm going to paint that right here. So there's the formatting, and then I'm just going to copy this cell down, auto-filling it down. There we have it. Let's go ahead and underline, font group, and underline. And if I was to sum this up, we should get to 100% again. And then I'm gonna multiply this out to see our depreciation for the new piece of equipment, 210,000 times the 20%. Going to simply copy that and paste it down, copy and paste. So there we have it. Let's put an underline here. If we were to sum it up, we should get back to the total that we would allocate over the 6 years, which would be the 210. So there's the 210 once again. So now that we have that, we got to compare what the difference would be. So if I'm looking 6 years into the future, what would the difference be, like my incremental depreciation, my depreciation under the new decision versus the old depreciation under the old decision, and what would then the tax benefit be on, the new decision, on the depreciation for the higher cost asset that we have. All right, so let's do that here. So we're going to say the incremental depreciation, I'm going to say is 1, 2, 3. We'll copy that down to 6 here. Let's copy that out down to 6. I'm going to center it, alignment, and center. Let's total this, total. And then I'm going to say the new depreciation for these periods. I'm just going to copy this down. Is that what we just calculated? And then the old depreciation, which is over here, I'm going to start on period 3 because that's everything from here forward. So period 1 on the new depreciation, when we make this decision, will line up to period 3 on the old piece of equipment if we were to keep the old piece of equipment. In other words, for the next year, if I was to do the old equipment, I would have 14.4 of depreciation and then consider the tax impact. If I went to the new equipment, I would have the depreciation of this first period, the 42, and then calculate the tax impact. Obviously, the new equipment will have a bigger depreciation because it's double declining balance. And again, if they had any other laws allowing us to depreciate more in year 1, we would depreciate more, which will have a tax benefit to it. So I'm going to say, all right, let's pick up then this period 3, the 14.4. I'm going to copy that down, say copy that. And we'll, hold on a second. And then we'll paste it on down to there, I believe. I can't paste. I can only copy. My finger's only going to the C and not to the V. So there we have that. And then nothing after that period, right? Because it had been fully depreciated after 4 more periods. So there we have that. Let's go ahead and sum these up just for the fun of it. We'll sum these up for the total. So equals the SUM. That comes up to the total for the new piece of equipment. This does not come up to the total for the old piece because we already depreciated the first 2 years in the past. So now we'll take the difference of the depreciation if we bought the new one minus the depreciation which would continue if we continued with the old one. Going to copy that on down. Let's put an underline at the bottom of that one and sum it up equals the SUM. And there we have that. Now, we could basically go here. Now, there's a couple different ways we can calculate this. We can then think about, okay, what would be the tax benefit then of this difference in depreciation? So let's do that. I could say, well, the tax rate we said was 35%. So let's bring this on over to 35% and say, let's percentify this whole column here. I'm going to select this column and go numbers group percentify, multiply this out. So the tax benefit 27.6 times 35%, we get a tax benefit there. I'm going to double click on this one, make it absolute, selecting F4 on the keyboard, $ before the B and 17, then drag it on down, do the same thing here. I'm just going to drag this on down, and there's our tax benefit. Let's sum this up just for the fun of it. There's our tax benefit, our incremental tax benefit between the difference between the two. And then once we have the incremental tax benefit, we might then take a look at the inflows, and I will do this another different way too, in a way that's more traditional that we've seen it formatted before. So again, you could format these tables different ways. But let's say we're going to now take a look at the savings that we're having, the tax impact of those. So let's say we have 1, 2, 3, 4, 5, 6. With the years, I'm going to go ahead and center that. So we're going to go to the alignment and center, and then pull in the savings. The savings are going to be equal to the 75 in year 1. So enter that. So these are what we think the benefit will be of the new equipment. I'm going to drag that on down. So there's our savings, which you can think of as kind of like the cash inflows, what we're going to save from by buying the new equipment and being more efficient with it. Totaling that, let's underline. Let's sum it up equals the SUM of that. And then we're considering the tax benefit here. Now here, we're looking at 1 minus the tax rate to see the tax benefit, because obviously the savings will result in basically the income going up. That's kind of like you could think of it as equivalent to a cash inflow. And then we're going to have to pay taxes on it, right? So if we think about the cash basis, how much of that $75,000 for year 1 do we get to keep without, paying Uncle Sam their silent partner? 1 minus the tax rate. That's how you calculate it. 1 minus the tax rate, which is 35%. So there we have it. And let's make this whole column a percent. by going to the numbers group percent define it. I'm going to double click on this one. The second item, I'm going to select F4 on the keyboard, $ before the B and 17, then copy it down. So we'll copy it down. So that represents how much we get to keep of the added savings that we got from the purchase of the new equipment. So we're going to say equals the 75,000 times the 65% and enter. Let's copy that down, copying that down so that we have that one more cell here. And then we'll underline, font group underline. Let's sum it up for the total tax savings. The sum of the tax savings. So there we have the savings over the period. So then the total benefit then, if we think about the savings that we have and the tax benefit that we calculated related to the incremental depreciation, we could put that into one table here. So let's do that. 1, 2, 3, 4, 5, 6. Going to center here. Going to put the total. And so we're going to say we had the depreciation benefit. So on the incremental depreciation of the 9660, going to copy that down. We're just copying that full column down here. And then I got the benefit up top from the savings that we get to keep 65% of. So we took into consideration the tax impacts, and now we could just add these two columns up with our trusty SUM formula. And we'll just simply sum that up. And then let's put some underlines down below. Font group underline. Let's sum it up this way. SUM. Summing this way. And then copy that across too. So that's a little bit different than the format that we've seen before. So let's see if we can put it in the format that we've kind of seen before. And this might be more recognizable. And once again, what you want to do is be able to see how, if someone was to put it in this format, that it wouldn't totally confuse you. You want to be able to change your perspective to see this in different formats, because that's really helpful to talk to other people with or try to interpret new things as it goes forward. So we could say, let's put this in our trusty, earnings before depreciation and taxation type of format. And so we had our earnings, for example, meaning this is going to be our tax benefit. So these are benefits that we're going to have from more efficiency, which we can think of as basically equivalent to income, right? So I'm going to say this is going to be tab. I'm just going to pull these numbers in a similar fashion as we have seen in the past. So tab, we're going to say this will be equal to, and then this one tab, and this is going to be equal to year 4. Year number 4 tab, and this is going to be equal to year number 5 is the 70 and tab, and then year number 6, and that's going to be the 65, okay? And then we've got the incremental depreciation. So here's the tricky piece. We still have to figure out the difference in the depreciation, which we did with this table over here, lining up the two depreciation tables so that we can find out the difference in the depreciation. Because if I went with the old decision, I'd still have some depreciation, which would result in a tax benefit. But the new equipment will have better tax benefits because you get a bigger depreciation. So here's the benefit. I'm picking up this column now, the difference between the two, subtracting the old and the new. So you still need this table. This is kind of the new thing that we would need to add in place here. And all because taxation is just totally messing things up. But that's okay. That's what we're here for. Taxes keep us in business. So there's the 27.6, the 27.6, and we're going to say tab, and then the year 2 tax benefit is the difference of the 58,560 tab, and then the year 3 benefit was the 31,680 tab, and then year 4, 19,872 tab, and then year 5 on the tax benefit is going to be the 24,192. Did I get this right? I think I did. Hopefully I didn't mess this up. I think I'm doing it. I think I picked them all up properly here. Tab. So I think that's good. I think I got them all. Let me just double check here. Does that look right? Yeah. I think that's right. Let's go ahead and underline those. Font group and underline. This will be our earnings before taxes then. So we'll do our earnings before taxes, same kind of process if you've been following along with some of the prior presentations here. Copying this out and pasting this down. Then we're going to apply the taxes. So now I'm applying the taxes all together here instead of doing this two separate ways, instead of thinking about the taxes related to this item and then the inflows, you know, the depreciation benefit and then the tax on the inflows. I'm doing it just at one point here because we got the earnings up top and then the incremental depreciation and now applying the taxes, which would be equal to, let's pull on over the 35%, and I'm going to say F4 on the keyboard to make that absolute times the 47.4. That's the tax. I'm going to say copy and then paste that on down, and that looks good. And then we've got the earn. Let's go ahead and underline this. Underline a line underneath that we call the underline, and then we got the earnings after taxes is the 47.4 minus the taxes. Copying that, paste that across, and then we're going to add back the incremental depreciation just as we saw before because it's not a cash flow thing. We only used it to see the tax effect on it. So now we're going to add it back in because we want to see a cash flow basis type of analysis so we can apply our present value calculations. All right, so let's go ahead and underline that. Makes perfect sense. Sense has been made again. I have made sense. Font group, underline. Some may disagree, but I feel like. And then this is going to be the sum of these two, earnings after taxes, and that one. And then I'm going to copy that, paste that across. So there we have it. So now we're finally to the point where we're basically at our cash flows again. And these are our cash flows. So now we can apply the net present value calculation using our discount rate. And if it comes up above 0, we might choose to replace. If not, we may choose not to. So we'll do this the horizontal and vertical fashion as we saw in some of our prior examples. Now note I put the years up top. That'll help us with the calculation. So I'm just going to pull down the same numbers first. Copy that, pull those on down. Those have been pulled down. I pulled them down. I grabbed them and pulled them down here. And then we got the present value of the cash flows. Doing our trusty present value calculation, negative PV, shift 9, rate all the way to the left. All the way to the left. We're looking at the 12% cost of capital. It might be called the required rate of return. It might be called the hurdle rate, discount rate. It includes the amount of gain that we want in there. Therefore, if the net present value is 0 or above, we might then take on the project because we got the required rate of return. Comma, we've got the number of periods, which is 1, which we're pulling up top so we can copy it across. Comma, comma, future value is going to be that 58,410. So there we have it. Let's do it one more time, and then I'll copy it across. Negative present value, shift 9, rate all the way to the left. Is that rate cost of capital 12%, F4 on the keyboard, making it absolute, comma, number of periods 2 this time, comma, comma, because it's not an annuity but present value of 1, picking up the 71,196 and enter. Let's copy it across now, see if it does what we expect it to. And I'm copied across, and then my expectations, have my expectations been fulfilled? It looks right there. Did it go all the way and pick up the right rate? Let's check it out by using this little tool, and that'll point to the other cell it's going to. You can find these, by the way, by going to, I think it's under the formulas right there, and then I would put them up top because I think they're really useful. And I can go back onto the left and say, yep, it's pulling it from that cell. That's exactly what I expected to happen, and what I expected to happen did indeed take place. And then we'll sum this up, summing up the ones to the left. And then we're going to add in the investment, which is time period 0, investment. This is going to be the outflow. And I'm picking up the net investment now, which is part of our first calculation. In other words, we sold it, we're going to buy it for $210,000, but we said that after we sell the old piece of equipment, basically our investment cash flow out would be the $175,950. So we're taking that as the cost of the new equipment minus the benefit, the inflow that we'll get from the old, That's going to be the 175,950. So then we get our net present value, the NPV. Summing this up equals the SUM. It's a positive number, so that would mean that we might be taking this on because we did indeed clear the hurdle rate. Let's do it one more way, the vertical way. So this way I'm going to start with 0, 1, 2, 3, 4, 5, 6. Center these and go to the alignment and center. Totals at the bottom. Total. And then we'll pick up the amounts, which will be equal to period 0 is that 175,950 this time. And then we'll just pick up our amounts on the inflows, which are going to be what we calculated here. So this one, year 2 is that one. And then year 3 is the other one. And then year 4 is that one. And then year 5 is this one. And then year 6 is the other one. So I think though, let's sum those up and just double check that works. That's the 172,250. If I sum these up, we get to the 348,000. And if I sum these up, we get to the 348 too. Okay, so I think that's right. So then we could do our present value calculations. Now this would be our net, basically cash flow, if we did not take into consider present value calculations. Now let's do the present value calculations. Negative PV shift 9, rate all the way to the left. And we're going to go on down to that 12%, F4 on the keyboard, comma, number of periods 0, which means the result will be the same, but I still want to calculate it so I can uniform this column and copy it down, comma, comma, future value, the 179,950. Let's copy it down, Control C, down, holding Shift, down, Control V, underline the bottom one, and then we will sum it up, equals the SUM of these items. See if we come out to that same 67,074. We do. So we've done it again. There it is. So that means it's above 0. So it's something we might pick up. Now you might ask, well, what is the rate? We know it's above the hurdle rate or the required rate of return, the cost of capital. What is the rate? Well, let's look at the IRR formula, which would be equals IRR. And that's going to be the sum of this whole column, and enter. And then we can go to the number group percent, add a couple decimals. It looks like 25.29. Also note that this 67,000 looks deceiving when you line it up to that 172, because you might think, well, if I take into consideration just inflation, then I made 67,074. That's not what this means, because we included our cost of capital required rate of return in this. So even if this was 0, we would have cleared the required rate of return, right? This is not just the cost of value of money in terms of inflation. So just to keep that out. And then let's go ahead and this internal rate of return is the rate at which this flow would be 0. That's the 25.29. Let's go ahead and make this fancy looking. Fancy it up, black and white on the color tonality, making this one blue for you, and then font group, and let's put some borders around it, border in it, and that looks excellent. So we're done.